Okay, good afternoon, ladies and gentlemen, and thank you for coming to today's webinar. My name is Emmanuel Ola, and I'm saying good afternoon to everyone who's currently on the channel. Please tell everybody we're live, we're around. It's time to learn about swing trading strategies. This is a session that you don't want to miss. This is a session that you don't even want your friends to miss. So please send out the words, let everybody know we're live and we're about to delve deeper into the market. It's going to be a really, really interesting session. I can tell you that. We're not just going to be talking. We're going to be doing some practicals. We're going to be doing some analysis. We're going to be looking at the chart, by the way. But at first, we need to first understand the concept, understand a few things about the concepts, and then we can get down to talking about how and some of the things you need to do and to know in order for you to be successful when it comes to trading swings in the market. Okay, so once again, welcome, everybody. Thank you for joining us today. It's a lovely afternoon right here at HFM Nigeria. And we're saying thank you guys for coming. Now, let us get straight to the business. You see, a lot of people would always have questions, especially pertaining to the financial market, questions relating to how long should I stay on a trade? In fact, you find some people who says, what am I supposed to trade? And then you'll find other questions like, what time frame should I be trading? Or what time frame is the best for me to trade? And then you would also find some people ask you some other questions like, so what should I use as my take profit? Or what should I use as my stop loss? And then you'll find some other people also say, what is the best strategy in terms of technical analysis that I can use to open positions in the market? And the truth is, every of these questions that I've just mentioned, they are viable and they all have answers, meaningful answers. And I think, to the best of our knowledge, we've covered a lot of those topics in 2024. If you go through the YouTube channel, you see that we've answered quite a lot of these topics this year. But today we want to deal with the question of, so how long should we take or should we stay on a trade? But we're going to be limiting our answer to swing trading. Because in actual sense, when it comes to staying on position or the duration of positions, we have, as you know it, scalping. We have day trading. We have intraday trading. And in the same way, we have the swing trading and the position holding, which is mostly separated by the duration to which you intend to stay on that particular position. So when we look at the disparity between all of these aforementioned strategies, swing, position holding, scalping, day trading, intraday trading, you can separate them into short-term trading styles and long-term trading styles. Yes, because for a reason, scalping, intraday, day trading are mostly short-term. You're opening your position for a short period of time, capped around 72 hours for intraday trading. As we all know, it's scalping over a short period of time. We also know that day trading is capped over 24 hours. But then you have the swing trading and the position holding, which is capped at least a week. It could run into multiple weeks. It could be 2 weeks, it could be 3 weeks, but at least minimum of a week, between 1 to 6 days minimum. and beyond. And then we have position holding, those who open positions for as much as 2 weeks, 1 month. They could even go as much as 3 months from time to time. So when we look at the disparity between both of them, we can't clearly say, okay, one side short term, one side long term. The question is, which one fits you? I hope at the end of the session today, you would have an answer to that. But before then, let us carefully consider what swing trading is. It's a swing trading is a trading strategy that focuses on profiting of changing trends in price action. Swing traders will try to capture upswings and downswings in stock prices or even financial markets. Financial instruments. It's not limited to stocks. It means swing traders are people who wants to get in on a move like this, but probably from here or from here. Or even if they could get in from here, but at least getting on a position that they could ride on for a long period of time. They could be on the same position for 3 days, but appropriately getting the entry correctly and riding on that move to the top. Because even if prices are actually going down, they are also interested in that move of the downside, but starting with the market like this. Let me join them before the trend is eventually established. You see, for a lot of people, we join trends when they are almost over. Maybe when it is somewhere around here is when you're ready to join the trend. But swing traders must have seen that direction for the next 1 week, 2 weeks. They feel like, okay, prices are going to rise. I'm going to lock it in now, and I'm going to get the best out of that position, which is maximizing the opportunity on one single instrument instead of limiting oneself to, can I make $3 or $2 from this? These people want to get as much as they can in terms of the opportunities in the market. They want to catch moves quickly, either up or down. They want to catch moves quickly and ride it over a long period of time, at least between 1 to 6 days and beyond. Now, you see, in order for you to get better or be able to take advantage of something like this, there are some key elements that must be put in place and that you must not, they are deal breakers. You cannot just be doing swing trading except these three things aligns. Number one, a viable entry point. A position that you want to trade over a period of time must definitely come with an entry point. Like definitely come with an entry point. But not just an entry point. An entry point that does not leave you at the mercies of the market. I was explaining something to people who were around, in a physical location in Port Harcourt yesterday, and I was telling them, I said, you could have the right decision and the right direction in terms of where you expect prices to go to, but you could eventually still lose that particular trade because of a wrong entry. You could be at the mercies of the market. So the right entry point, number one, is so important to any swing trading systems. And also an appropriate exit point. It means you cannot be looking to catch a swing trade or a viable position over a long period of time and then shortchange yourself. maybe a market that has the potentials of moving from this point to this point, whichever way he wants to achieve it, even if he wants to do this and this and this, and over a period of days, he continues to struggle, but then eventually still finds itself at this point, right? So if I'm able to get in on that particular move from here, understanding fully well that this is where the market looks to get to, it makes no sense when I now put an exit point of $5, for example. I then put an exit point somewhere here and say, I just want to come out here. I'm not doing it again. It's more or less like underpinning the potentials of that particular trade. Wrong exit point. You should maximize the opportunities when it comes to swing trading. And that's why appropriate setting of take profit is also very, very important. And when we talk about appropriate entry points and you talk about appropriate exit points, you also need an appropriate stop loss point. For some people, you want to get in on a position somewhere here. You have your entry here, maybe for an uptrend. And then when it is time for you to anchor your stop loss is here. And you intend to swing. That would never work. That would never work. You also need an appropriate level when it comes to setting stop losses for swing trades. So it can't be a random setup. It has to be a really quality setup for you to qualify as a swing trade. A quality setup. And a quality setup for swing trades must have a very, very appropriate entry point, a viable exit point, and an appropriate stop loss point. 3 points that are very, very important. Entry, exit, and stop loss. We're going to be looking at some of them with time. But ladies and gentlemen, let me tell you something. Even if you have a really nice entry point and a very viable exit point, and in fact, you have a solid stop loss, if you don't have this one thing, then I'm about to say it remains a problem. Listen to this, listen to this. If you have all of this, a good entry, a good exit, and a very nice stop loss, and you don't have this very point I'm about to mention, it remains a problem. And what am I talking about? The appropriate decisions. It means deciding deciding if you're going to go long or go short is so important. Determine if you're going to buy or sell is so important. Determine if the trend is going to be an uptrend or a downtrend is so important. It means before even considering entry, exit, stop loss point, have you considered the decision? Is it in line with the market? Is it a popular opinion? Does it have a global momentum backing it up? Because you cannot swing a trade over a period of time, 6 days, 1 week, 2 weeks, meaning you want a position to move in a single direction over a period of time. It It must have the backing of other traders. It must be a popular opinion. You cannot be the only one chasing that direction and then you're swinging it. You cannot check the sentiment tracker of that particular instrument and then you see that every other trader in the market are on buy positions, but you want to swing a sell. Just because you failed to find out what decision you're supposed to make before considering entry point, exit point, and stop loss point. It is possible to do everything right with technical analysis and still lose the swing trade because the decision entirely was wrong. The number one deal breaker that you want to ensure you don't miss when it comes to swing trading strategies is the right decisions. Do you want to go long or go short? Do you want to buy or do you want to sell? Do you want to chase an uptrend or do you want to chase a downtrend? Whatever you're willing to chase, do you have a backing? What is the catalyst? What is the catalyst or the backing for that particular direction? What can you see? What information do you have backing that specific direction? You need to get one. Why? Because it is only a direction that is backed by popular momentum that might be able to achieve what you are looking for in the period of a week. When you have decided that, then we can talk about, okay, your entry point, your exit point, and your stop loss point. Now, before we go to the chart, let us also consider some of the viable strategies that you need for swing trades. This is not everything, but this is some of the things that you must learn how to use in order for you to, really get a good angle of swing trading. Number one, Fibonacci retracement must not be far from you. You should actually learn how to trade Fib. We already have a very nice recording on trading Fib for our YouTube channel. So if you go to YouTube at HFM Nigeria, you'd see we have a recorded version on trading Fib. It's so important. You must also learn how to trade support and resistance. Yes, we also have that on our YouTube page. Really nice video as well on how to trade support and resistance, breakouts, retracements, all of that available. You should also be conversant with moving averages. It is so important as well when you want to trade swings. Okay, you must be comfortable with moving averages, the 50, the 100, the simple, the exponential. We also have a video recording on that, also on our YouTube page. And then you should also be comfortable with channels. In fact, channels is some of the most important patterns that you can chase for swing trades in the market. We're going to the chart now. But before then, there are some things and some questions that you need to ask yourself to decide if you're going to be a swing trader. We're going to come back to these questions after we're done with the session today, but have it at the back of your mind. Number one, if you don't mind holding your trades for several days, then swing trading might be for you. If you're willing to take fewer trades but more careful to ensure your trades are very good setups, then trading swing might be nice for you. If you don't have, if you don't mind having large stop losses as well, trading swing might be good for you. If you're patient to allow your setup click, then swing trading also might be for you. If you can also remain calm when trades move against you, also, you should also consider swing trading. It could really be a game changer for you. If you're not comfortable with all of the aforementioned reasons why you should consider swing trading, then honestly, it might really be difficult for you to enjoy swing trading because all these questions, all these, they're very key to swing trading. You must be patient enough. You must be able to allow, you know, big gaps between your entry point and your stop losses. You must be able to remain calm when you're losing position such that you don't quickly close trades that can still eventually move in the direction that to which you have already traded. This is key to swing trading. But enough of the talk. Let's go to the chart. Let's go to the chart and let's consider some things when it comes to swing trading. We posted something on our Telegram channel this morning. Let's go and look at gold. I have a picture on gold for you, and let's look at the upside that we've seen on gold since the beginning of um the month of December. I think for those who were around in the first Monday weekly meeting, I mentioned something. The seasonals for gold are very strong in December. Yes. According to the stats, at least 7 out of 9 Decembers ago, we've seen gold rise up until January. And I mentioned to them, December could really be a time to buy gold. And if you had bought gold since that time, this is what you could have had over that period. A really nice, consistent movement of prices to the top on strong seasonal patterns for the yellow metal. But listen to this, listen to this. Let's come back now because this is in the past. Let's think about the present. If we go looking for information on gold right now to see what we have, that would back what we think we should do in terms of market movement, right? I know some information that I can give to you, but I want you to do it as if it is you. So can we go searching for some information about the yellow metal and might give us maybe insight into maybe a swing position on gold, maybe? Or we just go looking for something. So let's just make a quick stop somewhere. Let's go somewhere. Let's go to FX Street and let's go to gold on FX Street. Oh, sorry, we cannot use FX Street right now. Let me just give you a background of what I'm about to say. So now listen to this. Gold has widely been supported by, a strong seasonals for December. We've also seen that reports suggest gold buying has resumed in China. Yes. According to report, China has resumed buying of gold, and the balance sheet for November showed a strong presence of buying gold in China and some other central banks. Which means, apart from the seasonals of gold being good, we also have central banks in China and other investors in China buying gold, which necessarily could play out into more upside for the yellow metal. Not only that, we still have some predictions from Goldman Sachs saying that we expect that gold will touch $3,000 in 2025. And we are still about 27, I think 2780 or thereabout, or 2790 is still the cap for gold this year. And we still have some reports saying 2025, we should actually get to 3,000. So, which means we have some really solid arguments for upside of gold. But then out of nowhere, yesterday, we saw a really positive information for the US dollar. PPI yesterday came in blazing hot for the dollar. PPI was strong, and that spot correction on gold, and price has continued to go down. Can you see? Over 2 days alone, price has dropped from 2725 and approaching about 2666 right now. That's a whole lot in 2 days. That's a whole lot in 2 days. But that's, by the way, the question for me now, if I was a swing trader, is has anything changed in the long run for gold? Is this PPI enough to change the tide for the yellow metal? So I begin to ask myself those questions because I want to swing. And if I'm going to swing, I need to be on that position for a long period of time. It means I cannot be bothered about day-to-day movement. I'm much more bothered about the outlook for the asset. So I'm thinking, okay, the seasonals is still suggesting that gold should be a buy market in December, but that seasonals is also hinged on the weakness of the US dollar. Yes. You see, the seasonals of gold being strong in December is also hanging on the fact that we believe that the US dollar would be weak in December. And we've not seen that play out so much yet. Because one way or the other, dollar still seems to be holding its ground this month. Although that might still change. You can see the performance of the dollar in December alone has been to the top. And that's a source of concern right now, right? This is a source of concern because the seasonals for dollar is suggesting weakness, but from what we can see, we're seeing strength. Consistently, the USD index has been rising in the month of December, and that's a stumbling block if I still believe that gold prices are going to rise. So I need to think about it. What is the forward guidance now for the dollar? And that might be something for me to consider for what I'm going to do with gold. Hey, then let's go back to the US dollar quickly. Let's look at the fundamentals of the dollar quickly. Just quickly, I want to look at yes. I want to see US dollar fundamentals. Let's look at next week. Let's just see this week and next week. This week started from this, and I want it to end next week, Friday. Yes, apply settings. Great. Now, when you see the economic data that re- um that has been released for the dollar in the last few days, you'd see that none of them has really impacted the dollar negatively. CPI was exactly what we were expecting. Core PPI was solid. A very nice print on core PPI yesterday, like I mentioned. We can see this, and eventually there is nothing again until next week. Okay, so let's look at next week for the US dollar. Wow. Look at what we have next week for US dollar. On Monday, we have flash manufacturing PMI and services PMI. On Tuesday, we have retail sales. And Wednesday, which is where I'm going to, we have the Federal Reserve announcing its monetary policy statement, which for me is the biggest event of the week. Now, my thoughts right now is, what do I think is going to happen to the US dollar next week with some of these economic events, especially with the Federal Reserve? I'm going to quickly take a look at what the market is saying about the Federal Reserve policy decision next week. So I'm just going to go to the CME Fed Watch tool, show you something. Wow. And right now, as we speak, the market is pricing in a 96.7% chance that the Federal Reserve is going to reduce their interest rate by 25 basis points next week on the 18th of December. So on the 18th of December, that is next week, Wednesday, it is almost 100% locked in. We believe the Federal Reserve is going to cut interest rate by 25 basis points, but that's not our problem. Our problem now is, what are they going to offer us in terms of future rate path? Because this is fully priced in. The question now is, what would the Federal Reserve offer us in terms of the future? What do we tend to get from them? Are they going to offer us more rate cuts maybe till first quarter 2025? Or are they going to say maybe this is the end of the cut cycle? Are they going to hold for a long period of time? It means we're at the crossroad of what we expect from the Federal Reserve. But by the way, if the Federal Reserve does cut interest rate by 25 basis points next week, there should still be some reactions for the US dollar, maybe not as big as the press conference offering us exactly what they intend to do in the future, which takes me back to the US dollar chart. And I'm looking at this and I'm like, okay, if they cut interest rate and they offer us more in terms of what they intend to do going into the future, and it suggests that they might still get some rate cuts this year, then hopefully the dollar can weaken next week. If I see supposedly weakness for the US dollar next week, then that's good news for my gold setup. If dollar should be weak, potentially from rate decisions, from negative data prints next week, from policy guidance from the Federal Reserve, then it means I could be looking at gold ending this week somewhere around 61.8. And then at 61.8, betting on the fact that dollar could weaken next week, hoping that gold can once again get bid from buyers, and prices could each another ride back up. I'm willing to swing this. Just as an example, I'm willing to swing this back to the top. That is, from this point, I expect that you wouldn't be able to go beyond this level. So I'm willing to swing this into next week, even up until Friday next week. Now, the question is, there is no certainty in this analysis. I'm not certain. How can I be certain? I don't control the market. All I've just done is I've gone through some certain bits of information, read some things, seen some things, drawn up a logical conclusion, hoping that that sits also with the market, which means I have a very solid support from 61.8 level on FIB. Also, not only is it a solid support, but actually a very significant level when you look at gold prices. If you look at it into the past, you'd see that the market actually has done a whole lot with this specific 61.8 level. It's not a joke level when it comes to price movement, actually. If you look at this level, it's market does not actually joke with this level. It's really a really significant price level. So if I look at that, there's more or less like a confluence between the normal support and resistance and what Fibonacci is saying on that particular position. So if I do that, and I feel like I could long from this particular position, banking on a negative week for dollar in its policy week, I could have something like this, for example. Please. Right. So I'm having a pending order on a really nice support level, like a really nice technical level with nice conferences from feed level down to support and resistance. And really, it's around 2660, which is really a very strong psychological level in the market. So that's a really solid entry. But with a solid entry must also come a solid exit point. Now think about it. What exit would I be willing to use for this particular position? And you're thinking maybe I should just come out here. By the way, you have to use the levels according to FIB to pick your exit point. You cannot just say, give me $2 or give me $3. You need to look at what's available for you in terms of resistance. There's a resistance here, there's one here, there's one here. In fact, there's one at this peak. The question for you is, how far do you think the market can go in that week that you intend to open that position for? Do you think the market can get 38.2? Do you think the market can get 23.6? Or do you even think the market can get as much as 2728? As the case may be. Now, in the case of me, I feel like next week might be the last really important trading week that we have, although it's not going to stop the market from moving. If you see the economic calendar for the rest of the month, even for the US dollar, you'd see that after this week, the market goes almost, you can see, after December 20th, the next few days are empty till next year. Till next year. So I feel like maybe if I'm even going to swing, I only have a week to swing, hoping that there's going to be enough price action, right? So, and I'm ready to consider my take profit. I decide to use a test of this level, 2700 again. I feel like 2700 again could be something for me to watch out for in the market. So I might be willing to put a take profit of 2700 here, modify. Now listen to this. For someone else, you might decide to use what's it called? This one here, and say you don't want to risk it. What if he just gets here and turn back? It's fine. At least you're getting yourself nice gaps. If you look at the distance between this point and this point, even on a 0.01 trade is about 250 price ticks. And I think in dollars is about $24 on 0.01. It's still fine. If you get this in 5 days, I think it's fair. You could also increase your lot to improve the value of that, because you could double that to 48 if you were using 0.02. Remember, just double it. If you're using 0.03, triple it. If you're using 0.05, multiply it by 5. Now, I have a solid entry and also a really solid exit at that, and a really solid backing, but I also need a stop loss. Now, some of you, your stop loss will be somewhere around here because you don't want to lose. Some of you, you are benevolent enough, your stop loss will be here. You're like, that's the most I can do. Some of you, your stop loss is even here, like this, and you are swinging. You want to swing it for a long period of time. For some people, it's even here, like this. But the truth is, a position that you want to swing, you cannot assume that the market will just immediately move in your favor. What if, just imagine that. Imagine that one way or the other, price gets here, but still able to push beyond this place a little bit before rising back up. But it has taken out your stop loss and you've lost the position just because you did not put a good level of stop loss in what you're doing. In that case, if you're going to swing this, you must be willing to take a level of drawdown. Look at this level here, right? This is also another key level of support right here. Right here. 2640. 2640 here is also another decent level of support right here. And this means there is still the risk of price. And you know how volatile gold is. You can't write it off. Even if price comes this way, it can still from here recover this much. Don't get it twisted. It is gold for a reason. It has that much volatility. So I don't want to be in an environment where price tries to go beyond this level to test maybe another mid-level of support here and meets me there, takes out my stop loss, and then I'm out of the market. In that case, my stop loss will need to be a little bit away from there. And that might mean having a stop loss somewhere around here. Even if I'm trying to be fair, it might mean having a stop loss just away from these swing points here. All these even this next one also is a really solid level of support. But let me just put it in such a way that it could still be something that you're willing to live with. If it was me, I'll most likely try to use something here. But then I need to consider my risk to reward ratio. So let's check. If I pull up a stop loss here, how many pips is this? It's about 350. And to my take profit is about 430. That's like 1:1.115. I feel like that's too much, and I think my risk to reward is not strong. So I might be willing to risk something around 2625, actually. No, 2630. So I might be willing to put my stop loss around 2630. Modify. Now, our job is not done, guys. Our job is not done. Now, if you look at this, let me take out the blue lines. Great. Look at this setup. Number one, this is a superb setup with really nice information. But your job is not done because at the same time, you also need to manage the trade. You also need to manage the trade. In what way? By adventure, on Monday morning, when you wake up, you can see price has tested and price has started moving up, small, small like that. You still need to do some in-trade management. Like, for example, you could use a trailing stop for your position such that the market can move your stop loss when price moves in your favor by a certain number of pips. And you could also do it manually. Maybe, for example, price has moved up to this point. You have no reason to still keep your stop loss this far away. You can adjust it a little bit. You can adjust it a little bit again, take it back up, modify. Again, maybe you are able to see that price does some things. Again, it has gotten now to this point. You don't need to keep your stop loss that far again. You could also adjust it further again. And if you're looking at the fact that the market momentum is still very strong and every information is still suggesting that prices will continue to rise, right? And it's not even Friday yet. You could also adjust this, in fact, expand it again and say, okay, if the market wants to give us more, why not? Let's take more. And then at this point, your stop loss needs to climb above your entry point. Don't worry, it will climb above it as long as price has moved considerably in your favor. Right now, I cannot do that because price has not moved in our favor. So I won't be allowed to move this stop loss above entry price. But you can do in-trade management to the point where even when price is already here, your take profit could be around 30, your stop loss could be around 38.2 already, following the market as price is moving consistently in your favor. It does not end in one entry and forget it. No, it still requires more on risk management and trade management. It is not a trade that you want to open and completely forget about it. No, you want to open it, you want to manage it accordingly, but you also want to ensure that you're calm and you can work under pressure, which means you're not going to close position just because you feel like you should close the position. Another market that I think fits swing is we had a really nice position on BTC, for a while. Why? Because it has public opinion, right? BTC has public opinion. Everybody wants to buy BTC because we're talking about upsides, price movements to the top. The question is, what's happening? Now, in as much as the current opinion is suggesting the presence of a buy, you still need to be very careful because away from the decision, away from what public sentiment is for that particular asset, yes, everybody wants to buy Bitcoin. In fact, I think yesterday I was reading something, and I think one company bought additional 500 million of BTC, I think yesterday. I'm not sure what company is it. Ah, what company? It's a very popular company, but at least 500. million worth of BTC. So it means actually people are still buying BTC. But so even if I intend to buy BTC because I feel like over a long period of time, prices will still rise, you still have to be very careful of the where, right? The where is very, very important. So if I think about it, if I draw levels, I'm not drawing levels of what's it called? Of selling. I'm drawing levels of buying. I'm thinking, okay, so in the situation where the descending triangle up there looks like it's going to eventually hold price. So what level can I look to come into the market? So I'm looking for some really nice support levels that can support the movement of prices. So I'm thinking if I get a movement up to this place, I could swing up a buy again, hopefully. If he decides to go as low as this, I could also swing a buy into the new year if I want. Even if price decides to go as low as this, which is almost impossible right now, the likelihood of price going back under 80, 87K, it's so slow. It might be something like this, or maybe something like this. You understand? But the idea is, I'm swinging the idea of price rising based on current opinion, public sentiment, market analysis. Companies are buying millions of BTCs every day. People are, cheering up the new or the recommended next SEC chairman. You see, it means public opinion has everybody buying. So why am I selling? I'm not meant to be selling. I should be buying, but the entry has to be spot on. If the entry is spot on, the stop loss also needs to be spot on, which means at any point in time, if I'm going to have, let's say, an entry point somewhere around here, for example, then my stop loss needs to come below this support level. I cannot be in within this environment. If you look at this environment, this is an environment where, look at this week. Can you imagine where this price dropped up to before eventually returning back? I don't want to have my stop loss anywhere around this environment where price can potentially do the same, what you guys always call a liquidity sweep, right? I don't want the market to use my own stop loss as another liquidity sweep. So I'm definitely not going to have my stop loss within that environment. It's definitely going to be somewhere below it, at least just a safe distance below it. That's swing. Holding positions based on public sentiment and general opinion, but over a period of time, a week, 2 weeks, maximizing positions, nice entries, great exits, but important stop loss points. Important stop loss points. I mean, there's a host of assets that you can actually look at, consider what's happening. For example, I am currently interested in what is going on with USD JPY and I think AUD JPY. Where's my USD JPY right here? You can see I've been trading it for a while. I've been monitoring it for a while. You can see I already have it marked. I don't take it away. Oh, superb. Look at that. My God. Look at consistent. Oh, consistency following the trend back up. Look at that. Look at that. Look at the absolute beauty, break and retest of really interesting level, and price has consistently been rising on USD JPY. The question is, where is price going to? Well, I have it here. Look at where my fib started from. This peak point up to the lowest point here. And according to fib, we're just around 61.8 level, which, by the way, is a really significant level. It's not a small level. I expect that price might struggle somewhere around this level here. And that for me might mean if this comes for me, I'm ready. I'm swinging it up. I'm not stopping, and I'm not stopping at 61 anymore. If it gives us that move, if it doesn't, if it gives us a break, just like it has done, A real test, I'm there. And when I get in, I'm not stopping until we get to a peak level again. Why? Because the market opinion is swinging against the JPY now. Hey, even if the dollar is not going to be strong next week, as long as the JPY also is not going to be strong, I can't be buying USD JPY. In fact, I should be buying USD JPY. Because also next week, we're going to be seeing the monetary policy decision from the Bank of Japan. If I include JPY to this list, you'd see that we also have a monetary policy decision for Japan next week. Yes, this is it. So the Japanese yen is also expected to weaken from this particular event, actually, because before the market held opinion that we're going to see price rise. The market had opinion that we were going to see JPY strong because we believed they were going to, hike interest rate by 25 basis points. But up until recently, we now started seeing some calls that, well, they're just going to leave it exactly where it is. They won't change it. And that is currently sending weakness for the JPY in the market. So if JPY continues to weaken, then buying USD JPY is a really solid option. In fact, a really, really solid option. It's just a question of what price action is willing to offer us here. If the market is willing to offer us a break above this, all we need is a retest. You can see that following every single break, we've been able to get retest. Look at it. Here, price comes after breaking, well, at this point, it gave us a retest. In fact, it gave us that retest like 3 times. 1, 2, 3 times. It went, broke above this one, and at the same time, offered us a retest before jumping. So if we see this and it continues, if it breaks this again, all we need is another retest and we should join the bandwagon. When we join the bandwagon, we don't want to limit ourselves to, how do I put it? 2 pips, $2. You already know where the market is going to. The market is aiming for an 100% reversal of this downside from November. November was crazy. We saw some really nice moves to the downside. You can see. So if the market is able to clear this, like clear, well, break, and offers us a retest, if I get in on this move, I'm not stopping until maybe somewhere around here. That's another level of resistance here, which might pose some risk, or I decide to wait for them until we get to the peak point. That's how to choose exit points, not the one that you just enter and once you see $2, you just close the trade and say you're done. I've made some money. You've not made enough. And you must be patient enough because the market is not going to go there over 2 hours. Might take time, might take you some days. It might even take you some days before it breaks and give you the retest, but you will not lose focus. You keep paying attention. That's a swing trade. Understanding how you expect the market to move in a period of time. We could also do the same on AED-JPY. We posted something on AED-JPY on the Telegram channel this morning. If you look at this, we also saw downsides from, I think, late October on AED-JPY. Oof. Apply a fee from the peak point to the lowest point. If you look at that, you can see price heading for honestly a really strong level of resistance around 38.2. But same with the US dollar. The JPY is expected to weaken next week, all things being equal. If nothing changes, we expect weakness for the JPY next week, which means buying AED JPY is still an option next week. Buying AED JPY is still an option until something changes, right? All things being equal. And that means if we can also see a clear break beyond this level, it will be really significant because this level has held price since like 27th of November. Since then, price has not been able to sustain a break beyond this level since that time. So if we are able to see a significant push beyond the level, one, and price offers us a retest of that level, why will you get in on the retest and then take $2 and go away? That's a level where you can enjoy at least a move towards 61 because that's the next best strong resistance that can hold price. Swing, nice entry, appropriate stop loss, you're good. So now again, we ask, understanding fully well that the art of swinging is the ability to understand how prices are expected to move over a period of time, combining it with some really nice technical setup, fee channels, ascending or descending triangles, as the case may be, finding the right entry, taking the right exit over time, and also appropriate stop loss. When you do all of this, it makes sense. It makes sense. So once again, we ask, are you sure you're ready to be a swing trader? Are you sure you don't mind holding your trades for several days? Are you sure you won't keep going back there every five minutes, five minutes, checking, watching, trying to see if you should close it or not? Are you sure you can hold your trades for several days? Are you willing to take fewer trades? Because swing trading requires you to be more careful, wait for setup, allow price break, expect it to come for a retest, waiting to see if a level is going to be respected. It takes time, which means you're not going to have the luxury of opening 10 positions. You might get one, two, three at most the whole week. Are you willing to trade like that? But the reward could be really fulfilling. Are you willing to take fewer trades? Don't you mind appropriate level for stop losses, which means having enough capital? It's not something you can be doing with $5. It's not something you can be doing with $10. Are you willing to take enough gaps as your stop loss? Are you willing to take a drawdown? Can you be patient enough to wait until setups are completed? Can you be patient enough to not say, I'm not making profit, I need to start trading? Can you be patient enough to say, I need this position to fit so that when I get it and I get it right, I could make a lot from it? Can you remain calm even when it does not look like the market is going in your favor? Can you be calm as long as price has not gotten to your stop loss? Can you be calm? Can you be calm even when the market is struggling to move and you're like, don't worry, I know where you are still going? Can you be calm? If you can do all of this, then ladies and gentlemen, you're ready to be a swing trader. There are individual videos that we currently have on our YouTube channel that can help you, especially with some of the concepts that we've talked about today. We cannot teach them again. We only have an hour for the session, but there are some concepts that we've recorded. For example, we've recorded price structure, chart patterns. We have recorded finding high probability entry and exit points in the market. We have also recorded trading moving averages and Fibonacci. This is so important. Trading moving averages and Fibonacci on its own, particularly. We've also recorded price structure on trading breakout pullbacks based on support and resistance. So some of those individual concepts that you need that could help you really solidify your swing trading, please go ahead and watch those videos. They are going to do you a lot of good. And HFM is also willing to assist you, help you in this journey of swing trading. Ladies and gentlemen, thank you for joining us in this session today. It's always important when you come around with us and we discuss things like this. On this note, we're going to be saying goodbye to our online audience. Thank you for joining. My name is Emmanuel Akiola, Market Analyst at HFM Nigeria. Thank you.